So welcome everyone. Welcome back to the Microstructure Exchange, another season. Today we have Stacey Jacobsen, who will tell us about AI-driven price discovery in corporate bonds. Before I give the screen to Stacey, we have the announcement of the Best Paper Award for the previous academic year. The winner is Daniel Chen, who had the paper Optimal Exchange Design. So big congrats to Daniel. If you missed the talk, I think the recording is still on our website, so you can check it out. Thanks also to everyone who voted for the Best Paper Award, and also to everyone who helped us with refereeing papers to choose the program for the autumn. Then we wanted to advertise the 2026 NYSE Market Microstructure Conference. The link to that one is also on our website, and they have the deadline for submission in the end of this month, September 30th. With that, I think we're ready to start. Stacey has asked us to hold the questions until 2 question breaks, about 15 and 30 minutes in. If you can't wait, or if you have clarification questions, you can post them in the chat. Kumar is also here. He's a co-author of the paper, and he will be able to respond to clarification questions. Okay, so with that, Stacey, take it away.
Great, thank you so much. Thanks for having us. We're excited to be part of this excellent forum and to get feedback on a relatively new paper that we are very excited about. This is co-authored with 2 of my SMU colleagues, Kumar Venkataraman and David Shu. And the title of the paper is Illiquidity Meets Intelligence, AI-Driven Price Discovery in Corporate Bonds. So let's think about the mechanisms for price discovery in the corporate bond market. So clearly, price discovery is a core function of financial markets. Why? Because we need reliable fair value signals to anchor negotiations between interested buyers and sellers. Transparency is a market feature that can support this process. However, the corporate bond market is quite opaque. There is very little pre-trade transparency. A centralized quotation system does not exist. Dealer quotes are available in some cases, but these are only indicative and distributed only to select market participants. Regulators have taken a lot of steps in the last few decades to increase post-trade transparency. Trades are now reported today within 15 minutes. And there are many studies that show that this disclosure and the timeliness of this disclosure have been beneficial to market participants. But the issue is that many bonds don't trade very often. So here we're showing histograms of the number of trades for each bond day. And if you focus on the white bars, you see that for all bonds, about 60% don't trade on any given day. And for small issues, this is more severe, where it's about 80%. Okay, so although the post-trade reporting is beneficial, when the prices are stale, they're less informative. So overall, there's limited benefit to post-trade disclosure with infrequent trading, which suggests in this market in particular that alternative mechanisms that are capable of signaling bond value in the absence of these trades could unlock substantial gains. And so the mechanism we're going to focus on today is AI-generated reference prices. So the other challenges in this market are the difficulty in aggregating disparate data, where many of the most important signals like dealer runs and axes still arrive via chat, email, or unstructured files. So we can naturally think of, machine learning algorithms being particularly good at bringing together these large volumes of unstructured data. All right, so in this study, we're going to ask whether AI-based pricing algorithms can improve price discovery in this market with infrequent trading. And to get at this, we're going to utilize data from Market Access. Many of you know this is a major electronic bond trading platform. And importantly, they're going to provide reference bid and ask prices through its proprietary CP Plus algorithm. So these are minute by minute reference prices. And we're going to use a lot of data in this study where we're going to look at more than 25 million trades, 12 billion CP Plus quotes, and more than 20,000 bonds. Okay, so what we really want to get at is whether these CP Plus, these AI reference generated reference prices can support intraday price discovery. And so we're going to get at this using 3 tests. So in our first test, we're going to look at whether it can facilitate price discovery between successive trades. So we're going to ask, can the CP Plus quote get closer to the next trade than the last observed trade itself? And we're going to do this by looking at normal trades, trades that generate large price movements, and trades that are associated with price reversals. In the second set of tests, we're going to think about the sources of CP Plus's informational advantage. And we're going to look at whether this comes from being able to incorporate in a timely manner kind of public market information, or whether it's coming from its proprietary data. In the third set of tests, we're going to look at CP Plus's value add. And we're going to look at it as a function of bond attributes. And namely, we're going to focus on bond liquidity and market conditions in periods of uncertainty. Okay, so that's kind of the big overview of where we're going. All right, so again, we're going to use the market access data. The great thing about this data is Market Access is the largest bond electronic trading platform out there. So it has a lot of proprietary data. In 2025, it executed about 20% of investment grade corporate bond volume and 13% of high yield bond trading volume. And as I mentioned, it provides minute by minute reference prices. So the benefits are we have this high frequency pricing data, but also on both sides, we have the bid and ask. And again, it's going to incorporate the private information that it learns from trades that are executed or maybe not executed on the market access platform itself. So the CP Plus algorithm ingests a lot of data. Clearly, it's going to ingest the trace trade data, where they're looking at trades in the same bond and in some cases related bonds. Also market-wide data related to interest rates and credit spreads. And also incorporates data from trades and other fixed income markets. Again, one of the benefits is the proprietary data that it observes, all of the RFQ inquiries, whether they're completed or not completed, and the entire stack of responses. It also incorporates dealer run information that's provided on market access. All right, so CP Plus clearly is powered by machine learning models. These models are trained each night, and the goal of the model is to produce the price the market is likely to trade at without a rich or cheap bias. So their goal is to produce the price, to forecast the price of the next trade. So once these are trained at night, throughout the day, it's going to ingest this intraday data, and it's going to provide real-time reference prices throughout the day. All right, so again, the benefit is the high frequency nature of CP plus. Unlike trades, we see that the average bond has more than 1,000 CP plus quotes per day. And we see that there's broad coverage by CP plus. In our sample, about 91% of bonds are covered by CP plus. So I think it's a natural question to ask whether, given the frequency and given the coverage, whether these, AI generated reference prices can support intraday price discovery, particularly in the corporate bond market, where in many cases we lack trades as signals. All right, so here's a quick summary of the results I'm going to show in the coming minutes. So we find that the most recent CP plus quote is more informative about the next trade price than the most recent trade price, particularly when the trade intervals are long. We consider the sources of CP Plus's advantage, and we find it comes both from public, so the timely incorporation of market-wide signals, and from proprietary sources such as observing the RFQ process. We think about how CP Plus adds value in the time series and in the cross section, and we find that CP Plus adds value especially for moderately illiquid bonds and during periods of elevated market uncertainty. So for moderately illiquid bonds, there's not enough trading data for, not enough transaction data for a trader to kind of do a good job pricing the bond, but there's enough trades to be fed into the algorithm so that it can produce kind of an informative reference price. The final thing we find is that CP Plus relies heavily on realized trades. So we find that following a trade, CP Plus will update quickly in the same direction, and that this reliance on trades limits its contributions during periods with large transitory price shocks. So we're going to look at periods of reversals. All right, so let me give a quick overview of our methodology for this paper, and we're going to use this for many tests. So to understand kind of the contributions of CP plus, we're going to start by looking at whether it can aid in price discovery between trades. So let's think about a trader. The trader desires to trade at time t, and this trader must estimate the bond's current value. Okay, the trader may not observe dealer runs. So a reasonable starting point is that the trader can observe the most recent trade price that occurred at time t minus 1. Okay, and let's relate this to another trader who is a subscriber to Market Access, who observes these CP plus quotes that are often released each minute. So our successive trade analysis is going to compare two deviations. First, the trade deviation, where we're going to take that current trade at time t, and we're going to find the absolute distance in price relative to the last trade observed at time t minus 1. We're then going to compute quote deviations as the absolute distance between the current trade price at time t and the CP plus midpoint that we observe prior to the trade. And we're going to measure two quote deviations. We're going to take the midpoint the minute prior to the trade, and we're going to take the midpoint the day prior to the trade. So we're going to have one trade deviation and two quote deviations. And later we'll do something more sophisticated and we'll adjust last trade prices for market movements. All right, so to be clear, we're asking which benchmark the last trade or the last CP plus quote is closer to the current trade. So let's take an example. We have a current trade that occurs on Wednesday, January 3rd at 4:25. My trade deviation is comparing it to the last trade in this example that occurred 2 days ago on Monday. My quote deviation is comparing this current trade to the CP plus quote that we observed 1 minute before at 4:24. And my second measure of quote deviation is comparing it to the quote we observed the day before, in this case, Tuesday at end of day. So one thing before we get deep into the results, I want to point out is that our deviations in some cases will include a half spread. So if you think about the fact that we're using the CP plus midpoint quote, our CP plus quote deviation will always include a half spread. Our trade deviations, half of the time, will include a full spread. So for example, if this last trade was a buy and this next trade was a sell, then we're going to include a full spread. Okay, so in expectation, the deviation for both measures is a half spread. And so what we care about is the relative comparison. So we think these things will work out. However, to validate this, we're also going to focus on same signed trades, where that last trade, for example, was buyer initiated and the current trade is buyer initiated. And then we're going to use the CP plus bid or ask. Okay, so in this sample, we're going to remove any impact of spreads. All right, so I'm going to show you some preliminary results on these deviations. So throughout this analysis, we're going to report the deviations by the time elapsed since the last trade. For example, the last trade was same day up to more than 20 days. And also I want to point out that all else equal, we want the deviations to be lower. So lower deviations indicate that the benchmark is closer to the next trade price. So we're going to compare the black to the red. The black is our trade deviations. The red is our CP plus quote deviations. And we see when the interval between trades is long, these deviations are economically large. They remain large as the as the time between trades decline, but the gap declines. So overall, we're starting to see that the CP plus quote is more accurate than the last trade in predicting the current trade price, especially when the elapsed time between trades is large. So all of these are quote deviations are statistically lower. However, we can look at trades that occur on the same day, and we see that very little difference between the trade and the quote deviations. So here we're going to zoom in on cases where the last trade was hours from the current trade. Okay, and we're going to report it by, again, hours. And we're going to see that when the last trade was more than 1 hour ago, we see that the CP plus quote deviations continue to outperform and statistically significantly so. However, when the last trade was in the same hour, we no longer observe this outperformance. In these cases, trades can stand on their own. Trades are already incorporating timely information related to market and bond characteristics. All right, and before we pause for questions, I'll show one more picture that we think is an important part of this paper. So we want to think about kind of how CP plus's value add varies with bond characteristics. And one kind of natural place to start is looking at the liquidity of the bond. Why does this matter? Well, clearly, these reference prices are going to be more important when the bond doesn't trade. However, we need trade prices to feed into the algorithm itself. So we're going to measure the value added of CP plus on the y-axis, and this is simply the differences in deviation. So this just means that the CP plus benchmark was closer than the last trade price. And we're going to show this value add throughout by 100 liquidity bins that are formed on prior month liquidity. And we're going to show average differences in deviations. And so the red line shows that when we're on the far left side and where I have low liquidity, as we increase liquidity, we find that CP plus value added increases. Okay, and this makes sense because we're giving more trades to the algorithm so that it can produce, more informative reference prices. At some point, as liquidity increases, we start to see a decline. In these cases, the trades themselves are becoming more timely, and the value add of CP plus starts to decline. So the important thing, though, is that we see that the red value add is positive throughout all liquidity events. So overall, the relationship between CP plus and CP liquidity is nonlinear and bell-shaped and seems to be kind of optimal when we have moderate illiquidity. We don't have enough trades to like price the bonds, but we have enough trades to feed into the CP plus algorithm. Okay, and I will pause for questions at this point.
Yeah, PK, go ahead.
Oh, okay, thank you. Yeah, I know there is a lot of hype about AI these days, so it's good to include that in the title. But is it mostly the result is because of the proprietary information, like the quotes and the other things that they have? They are using that to give a reference price, right? So I don't know what's so much AI about it, but simply bringing proprietary information to the market. And then once you guide it, then obviously the next trade will happen based on that reference price, because everybody wants to trade at the right value.
Yeah, that's a good question. So we're not going to explicitly get at that, but we have some evidence. So we do have some evidence that when that proprietary information is when we're observing RFQs between trades, it does do better. So that is part of it. But we also observe pretty large performance gains in CP plus for bonds that maybe we would expect this to be less valuable. For example, we still see gains for investment grade bonds and so forth. But yes, that's an interesting question, and that's something that we haven't kind of clearly been able to have a strong say on. So
Marius and then Simon.
Hi, Stacey. Thanks a lot for this. Is very interesting. It seems to me that you're showing two things. First, that there is price discovery through quotes, which doesn't strike me as very surprising. But what I find more interesting is that the deviation from the last quote actually increases with the time from the last trade. So it seems to me that the price discovery through quotes also depends on the trading process, and is not just the dealers estimate some fundamental that they always have in the background and always update their quote. So I'm wondering if you have any mechanism for that.
yeah, so I'm not sure I'm understanding your question, but yeah, if I did, the reason that we're finding that the deviations increase is just because that the trades that we observed 20 days ago are rather stale. However, we do find that even if we adjust these last trades for market movements, that we still see kind of outperformance from CP plus. But I'm not sure I understood your question, so let me know if I didn't.
No, I think my question was that the difference between the last minute quote and the next trade actually depends on the time elapsed from the previous trade. And I would have been thinking that all the dealers actually have a accurate model to price these bonds minute by minute. So then, regardless of how stale the trade history is, they're always pricing it right.
Yeah,
You just don't see the trades. You just don't see the trades.
Stacey, may I just jump in? Yeah, I think you're right. We do find those patterns, and I think it just reflects that even the algorithm is relying on trade data. So, it reflects
exactly
on attributes, and it reflects market conditions when there is not that much, sort of information being produced. We show in some other analysis that, once a trade gets reported, if you follow the CP plus midpoint quote, it responds to that new trade information. And, within 5 minutes, sort of it reflects and moves in the direction of that trade price. Yeah. So it is relying on the trade data. And as you have less and less trade data, it may just reflect attributes of the bond or market conditions where there is just, less information being fed more generally to it, and therefore you're seeing that increase.
Yeah, that's interesting. Price discovery and quote discovery are not orthogonal, like price discovery for trades and quotes. Thank you.
Hi, Stacey. Thanks for the presentation. I just wanted to know, have you done the exercise by splitting the last trade into whether it was interdealer trade or whether it was D2C? I'm asking you because in a way, what you do is by computing a deviation from the CC plus, it's basically like measuring the half spread as well. I mean, this is what you would do, right? If CV plus is just your benchmark. But no one would really, I think, just use the last trade in order to compute the transaction cost in the market. To understand that you're doing your prediction exercise, but in a way, you're also saying something about the accuracy of measuring transaction costs. So, and here many people would just use the last interdealer price. So I wondered whether you've done that exercise to say something on that.
No, we haven't done that, and it's a good idea. That's something we can do. Yeah. So I think that, yeah, when we do something like that, we'll be picking up last trades that are even more stale. But I see your point, and I think that's something that we could by all means do. Yeah. So at this point, where the last trade can be either a customer or interdealer price, the only restriction we're putting on it is we're not allowing it to be a small trade.
So let's do one more question and then we can continue with the presentation. Tavi. We can't hear you, Tavi.
I mean, I think this is an amazing paper and I learned so much. I didn't have a chance to read it more carefully. I just skimmed it. But did you also look at the difference between these deviations for bonds that have many bonds issued per firm versus those that have less? Because that might go to the AI question, right? In terms of, is it just providing more information? Similar to the staleness thing, right? Is it just providing more information? Because when you have more bonds, you expect that traders already can observe other price inputs that can help them inform their decisions.
Yeah, that's a good idea. We haven't done that, and that's been by all means on our to-do list, is to do a better job looking at the information that's out there and the same issues for the same issuers, but also looking at information that's coming from similar bonds that we can obtain from the market. No, we haven't done that, but I think that's a great idea. So
super paper.
Yeah, we do find though that, kind of getting at your question, that the value add is higher for, these smaller issues, which may be correlated with, the number of bonds outstanding for the issuer. So,
and lastly, not to take too much time, but in the same vein, did you differentiate between the bonds that you might want to call quote unquote on the run and not? Because again, there's more information, but that would kind of be within the analysis of how frequently they trade.
Yeah, no, that's definitely something we can do. And I like all of these ideas, and I think that it kind of helps differentiate as to exactly what we're picking up, whether it's data or the algorithm itself. So these are great ideas. Thank you.
Thank you. I hope to talk more sometime about it.
Sure. Thank you.
Okay, so there are no more questions at the moment, so let's continue.
Okay. All right, so let's talk about the related literature. So there are recent papers, including by my co-author Kumar, that are asking whether these dealer indicative quotes, which are selectively broadcast to market participants, are informative. In general, they find that these are, which is related to our paper. There's also a lot of papers that are using the market access data that are looking at kind of the prevalence of trading on these platforms and the types of bonds. but also recent papers that are looking at kind of the RFQ process and kind of search outcomes. And there's a growing literature that's, using this big data plus machine learning techniques. And overall, these papers in general find that, when these techniques can handle nonlinearities, they can handle complex interactions, that they generally do a pretty good job forecasting, for example, returns and illiquidity in the fixed income market. All right, so let's get into more detail. So our data is merging FISD bond characteristics with TRACE. This is the trade data with two market access data sets, the CP plus bid and reference ask prices. This is our main data set, but also the RFQ data. And our sample is from 2017 to 2023. And as I mentioned earlier, we're going to use a lot of data. Overall, we are going to look at 25 million trades and 20 billion CP plus quotes, of which 6.5 billion are updates, meaning the reference or the bid changed. In terms of daily activity, again, we're kind of going to see that we have about 3 trades on average per bond per day, more than 1,100 quotes, and more than 300 quote updates. All right, so one quick simple test that we wanted to kind of bring home the impact of infrequent trading in the corporate bond market was doing some autocorrelation tests. So we're going to take trade prices and we're going to create time-weighted average prices to compute daily trade returns. And we're also going to compute daily CP plus returns. And we're going to put these into portfolios and we're going to estimate daily autocorrelation coefficients. And what we see, not necessarily surprisingly, is that, for example, lag 1 trade correlation is large and positive at 0.86, whereas it's 0.52 for quotes. By the time we get to lag 5, it's still quite high for trades. So overall, we see that, a trader that's utilizing these trade-based returns is going to face a lot more return staleness than a trader that's using the CP plus quotes. All right, so let's get to kind of the main point of the paper where we're looking at the informativeness of CP plus reference prices. And I showed you some visual evidence, so this will just kind of support those pictures. But now we're looking at deviation differences. This is the trade deviation minus the CP plus quote deviation. So right, when these are positive, this means that CP plus is closest to the next trade. And we're going to report this by the time elapsed since the last trade, whether it was more than 5 days ago down to 1 hour. And we're going to report differences for the whole sample, as well as that same sign sample where we're kind of getting at that spread issue. So we find that these deviation differences, when the time elapsed between trades is more than 5 days, are economically large at about 44 cents. When it's 1 to 5 days, they're at about 15 cents. And when it's at 1 hour to 1 day, they're at about 5 cents. So for these time intervals, we see that the CP plus quote is more accurate in predicting the current trade price. And we see that when we make that spread adjustment, that we see very little changes in our deviations. But again, when we start looking at last trades that were less than an hour ago, CP plus no longer outperforms. Here, the trades do very well, right? So the trades are already reflecting, timely market information and any bond specific information. Our results are robust to looking at many different sizes of trades, but we, by all means, can also look at whether the last trade was interdealer. And we find that CP plus outperforms across various cuts of the data. All right, so in the next part, we're going to think about the economic significance of these price contributions of CP plus. And we're going to ask how well do the CP plus quote returns anticipate large trade-to-trade returns? And so here we're going to isolate the informational value of CP plus update between trades, where the price discovery is not obtained from trade signals, but from other public or proprietary signals. So we're going to first compute between trade bond returns, so trades between time t and t-1. And then we're going to compute quote returns. And we're going to compute 3 quote returns. One that's between the trade at t-1 and the CP plus midpoint 1 minute before the trade. The second measure will be the return between t-1 and 1 day, and the third between t-1 and 2 days. So we're going to take these, we're going to regress these trade returns on each of these 3 CP plus quote returns. And then we're going to report the R squared, because what we care about is how well does CP plus capture variation in trade-to-trade price movements. Okay, and there's a lot of color on this picture, but overall we're going to see that CP plus does a pretty good job capturing these large returns. So on the left we report trade-to-trade returns that are of a moderate size, and on the right, those that are large and exceed 3%. And we're going to run the regression separately for each number of trading days between trades. So for whether the last trade was 20 days ago down to 1 day ago. And the dots represent the R squared. So let's look at when the number of trading days was 5 days ago. We find that the CP plus return using the prior minute captures 70% of these trade-to-trade returns. Even if we use the CP plus midpoint the day before, we've captured 40% of these trade-to-trade returns. And even 2 days before, we've captured 30%. Okay, even when we focus on large returns, we see that CP plus is able to capture a large portion of the variation. Okay, so we're starting to see that these contributions are economically large. And we can also look at large trade-to-trade returns when the last trade was hours ago rather than days ago. And we still see high R squareds, which indicates that even in fast trading environments, the CP plus quote discovers about 20 to 70% of these trade returns prior to the trade. All right, so we're going to start. So we've seen some evidence that CP plus seems to do well predicting the next trade, and we're going to kind of get at why, and we're going to think about whether this comes from incorporating public signals or private signals. And again, one benefit is it can quickly incorporate broader market conditions. However, a trader who wants to trade at time t can also take that t-1 trade price and adjust it for market conditions. So we're just going to do a very simple adjustment, and we're going to adjust that last trade price at t-1 to incorporate the maturity matched treasury security return, or to incorporate the S&P 500 corporate bond index return. So once again, we're going to report differences and deviations. And we're going to report it by the time since the last trade. And we're going to start in the first column. This is our unadjusted. We've already seen this. Without adjustments, we find that when the last trade was 5 days ago, that the difference in deviation is 44 cents. When we adjust for treasury returns, this declines to 29 cents. So this seems to help. It helps for other intervals, but it helps less so because when the trade is more recent, it's already reflecting these market movements. In the third and the fifth column, we're going to compare what happens when we adjust for credit index adjustment. So unadjusted, the deviation difference is 33 cents versus the adjustment reduces it down to 29 cents. So these help a little bit, but less than the Treasury adjustments. But overall, for most intervals, the CP plus deviation is lower, indicating that even after we make these standard adjustments for interest rate and credit risk, it still outperforms. So we want to kind of understand better what CP plus quotes are reflecting. And we're going to take daily CP plus returns, and we are going to regress them on a set of market returns. And we see that CP plus is indeed kind of responding quickly to broad market movements related to Treasury, credit, equity, and option markets. And these R squareds are somewhat high. All right, so we had some questions about the private signals. So clearly, in addition to public signals, CP plus observes the entire stack of the RFQ responses. And so what we're going to do now is we're going to identify trades that had an RFQ in the same bond between the current and the last trade. And so by definition, we're looking at between trades. We can't observe completed RFQs, but we can observe RFQs that were missed. These are did not trade RFQs. So either the submitter didn't like the quote responses or nobody responded. And we're also going to look at between trade delayed spot RFQs. So these, if you're unfamiliar, are cases where, for example, the spread to the benchmark Treasury is agreed upon, say, at 11 a.m., but the final dollar price is calculated and spotted at 4 p.m. So in these cases, the terms are observed in the morning, but this isn't reported till the end of the day. So here, market access has some kind of private signals before it's reported to the public. So we're going to do, in a similar table to what we've seen before, we're going to look at differences and deviations. And we're going to find pretty big gains in CP plus performance when an RFQ is observed between trades. So for example, when we did not observe a missed RFQ, the difference is 35 cents. However, if we do observe between trades a missed RFQ, this jumps to 51 cents. Likewise, if we did not observe a delayed spot RFQ in the previous 5 days, our deviation difference is 40 cents, but if we did, the deviation difference jumps to 70 cents. Okay, so overall, this proprietary information from the RFQ process seems to be a pretty big advantage for the pricing algorithm, although this advantage declines as the time between trades reduces, right? Because now trades are starting to reflect some of this information. All right, I will skip a few things. All right, so in the final part of the analysis, we're going to shift gears. So before we were looking at CP plus quotes before the next trade. So now we're going to think about how does CP plus adjust after a trade, okay? And so let's think about this. The AI algorithm on one hand can help stabilize markets by identifying information events and producing reference prices that speed up convergence to fundamental value. However, CP plus has been clear that it's designed to estimate the price of the next trade, which may not necessarily be the fundamental value. So I won't show it in the interest of time, but we show that CP plus quotes update quickly in the direction of the trade. So within 5 minutes after a trade, we see that CP plus quotes updates pretty quickly. So we're going to kind of think about this now in the context of trades that have large price effects. So we're going to look at quotes after large block trades. And we're going to focus on block trades with either large permanent price effects or large temporary price effects. So we're looking at reversals. So big shocks, either permanent shocks to fundamental value or temporary dislocations. And what we're going to do is we're going to have a slightly different methodology here. So we're going to compute average trade prices each day around the event, and we're going to compute average CP plus quote prices each day around the event. So we're going to look 10 days before and 10 days after. Okay. We're then going to compare this to the price after the event, which we choose as T plus 10. So this is going to be our proxy for the post-block fundamental value. And we're going to see how quickly that trades or quotes moves towards this T plus 10. So that's going to be our deviation. All right, so the top two pictures show bond block trades that have large permanent price impacts. And we're going to look at this based on bonds that are less active relative to bonds that are more active. And again, the deviations are picking up differences, for example, in blue, between the trade price on day -5 and the trade price 10 days after the block. So for both, we see, and the red will pick up the CP plus quote deviations. For both, we see that the deviations are large prior to the block. Once the block is announced, we see big declines in deviations, and deviations decline gradually thereafter. For the most active bonds, we see that CP plus deviations closely track the trade deviations. All right, so what we're most interested in is these blocks that create temporary short-term dislocations. So in the bottom pictures, we're looking at those with temporary price impact. And again, for the least active and for the more active bonds. For both, we see that prior to the block report, these deviations relative to the day 10 price are low. Once the block is reported, we see these deviations are high. And we see that these deviations start to reverse as the temporary price impact reverses. So when we're looking at the least active bonds, we see some evidence that the CP plus deviations are lower, but these aren't statistically lower. For the most active bonds, we see that the CP plus quote deviations are closely tracking the trade deviations, even during the period of dislocation. Okay, so kind of the main point of this picture is that CP plus relies heavily on trade data, and this can limit its contribution when market prices are distorted. So to conclude, almost on time, in illiquid markets, AI-generated reference prices could add significant value. This infrequent trading limits the benefits of post-trade transparency, and these models can help fill information gaps between the trades. We find that CP plus quotes are more informative than the most recent trade price, particularly when trade intervals are long. We find that the sources of CP Plus's information advantage are both from public and private information sources, and we find its contributions to price discovery exhibit a bell-shaped pattern with bond liquidity. And finally, we showed that CP Plus relies heavily on recent trades, which can limit its contribution in periods with transitory price effects. So with that, I will start questions.
All right, thank you very much, Stacey. So let's open up to questions. And Stacey has said that she's able to stay past the top of the hour in case we have enough questions to take us beyond that point. But PK, I see your hand is up. Why don't you take it away?
Oh, okay, thank you. Yeah, very exciting paper. I always used to wonder why there is not an exchange or real like quotable market for bonds. So this looks like there was an opportunity and people were late to come on, but somebody is finally coming through. But how is it different from like Bloomberg? Aren't there other competitors to this who also provide quotes? I thought Bloomberg was a leader, right, in the bond trading.
Yeah, I totally agree. And this is probably a pretty profitable type business, so there are competitors coming. I think in terms of market access's biggest competitor, it would definitely be Bloomberg. And Bloomberg is also providing intraday prices. And I think there's another platform called Solve But my understanding is that that the take up on the CP plus data has grown quite a bit. But yes, I would say Bloomberg. We have not looked at how this product compares to other products. But we do know that Market Access recently formed a partnership with S&P, where the S&P end-of-day evaluated prices are now going to start, I think, incorporating the CP plus data. So yeah, there's growing competition.
Interesting. Yeah, great.
Okay, Simon and then Tabby.
Hey, two things. The first one is regarding the importance of quotes and maybe also disagreement across quotes by dealers. I wondered whether it could be interesting to look at how well different bonds are covered by different dealers. So some bonds, maybe dealers are very specialized in, so you may have only one dealer that actually deals in that bond, or just very few, versus others where you have many. And I would expect somehow then, for the RFQ information to matter in that case, because for some bonds you may only have one dealer to respond actually, and for others you have more. So maybe knowing, I don't know, maybe the number of underwriters or just how often the bond is traded by different dealers could help you disentangle a little bit the importance of actually these quotes for the CP plus price. And then the other thing I wanted is that, so CP plus prices are supposed to be used by the traders. So to what how would this influence your exercise, given that, in this very opaque market, and at some point, traders say, great, I have CP plus, so this is all that I rely on. So whatever price, you get quoted, which is then close to that reference price, you pick, and then sort of automatically, you have that, observed prices are just close to the CP plus price. Have you looked a little bit into that?
So are you saying how often are they using, let me make sure I understand, is the CP plus price generating the next, creating the next trade price? Is that what you're getting at?
Yeah, I mean, there's the potential for that, if just traders heavily rely on that CP plus price to basically make their trade decision and know, when to trade and maybe then when not to trade. The benchmark in the end is used to inform your trading decision. And so the price, in the end, the execution price will somewhat be driven by actually the reference price that you observe. So,
Stacey, may I jump in on this one?
Sure.
So yeah, Simon, you're right. I think we have some discussions in the paper about this, which is that, if people are using this reference price as a basis for negotiation, then as the CP plus price gets thrown out, you may see trades closer to it. And I think this becomes particularly problematic when you have some sort of transitory price shocks, price pressure events, etc. Because in those circumstances, the fundamental value may actually be different from where some of the trades are occurring, but the CP plus has, it's designed to sort of forecast the next trade price, not necessarily the fundamental value. So if they're throwing out reference prices which are further away from fundamental value because they are trying to predict the next trade price, then it can lead to negotiations, and therefore the next trade that happens again, even further away, it amplifies the price dislocation rather than alleviates and converges quickly to a fundamental value. So I think that's something that we talk about in the paper. Our temporary price impact analysis that Stacey talked about is getting to the spirit of that problem, trying to see, to what extent we see that in the data. It can probably be further developed, but I think the spirit of what you're saying is something that we have thought about, discussed in the paper, and we have some empirical results related to that.
Thanks.
Yeah, thanks also for the comment on looking at kind of the number of dealers intermediating the bond. That's a great idea. Tavy, do you want to?
Yeah, I guess my question in spirit is sort of like Simon's. So if I think about market efficiency, right, about efficiency or price efficiency, then certainly the block trade analysis, as Kumar just said, it sort of gets to that. But if I'm understanding this correctly, and also through your answer to Simon, so the benchmark for the rest of the analysis is how close are you getting to the following trade, right? So I guess I'm just struggling to understand what that tells me. And I love this paper, and I'm going to go back and read it more carefully. So I apologize if you address this. For example, also, I think that would be very different in different scenarios. So for example, when you look at the less than 1 minute sample, then of course within there, some of those trades are algorithmic already, or they're split trades from a much larger trade. So when you're looking at the next trade, and I think your next trade is a minute away, right? But still, they're already sort of intrinsically programmed to be close to one another. So, and that's very different from when you have, the last trade was 5 days ago. So there's different types of scenarios, different sizes, different ages. So I guess I'm trying to understand what that tells me to compare to the following trade.
Yeah, we see your point. This is something that we've thought about. Ideally, we'd have a true price, fundamental price that we could compare it to throughout. So in our successive trade analysis, we are assuming that the next trade is kind of getting close to that. And yeah, so your points are well taken. We do our best. You know, we look at kind of large trades that maybe closer to fundamental value. We also exclude trades that we think are prearranged trades. So we're trying to get at that. You're right.
I actually wasn't trying to make a point at all. I was really trying to ask, like what do I learn from it? I wasn't, you know, I really wasn't making a point. I was more asking you how to think about it.
Yeah. So I mean, I guess the main results that we're finding are that if a trader wants to know what the next trade is going to look like, that CP Plus does a pretty good job.
Okay.
But we're not able to say anything necessarily beyond that. But again, the final analysis shows that there are cases where the next trade is clearly not reflecting fundamentals at that time, but CP Plus is tracking that.
So that really
can I jump
helps.
into
So it is
Stacey here?
informative. It is informative. It's informative with respect to where the market will be very soon. And that's extremely helpful. Okay, thank you.
I think there are several analyses in the paper that gets to showing what the CP Plus quote update reflects, Tavi. So, you know, we have some regression showing that if you compare the CP Plus quote updates to, you know, market-wide signals from treasury market, from the bond market, you know, from stock market, the VIX changes, etc., you find that there's correlation between how the CP Plus updates and market-wide signals move. And then we also show that CP Plus appears to be picking up information from the RFQ process. And you know, when it does pick up that information, the deviations actually are smaller in the sense that it's closer to the next trade price. So it looks like it's picking up, you know, what we think would be relevant fundamental information. So in these analysis, you know, we are sort of not specifically looking at the next trade price, but we are looking at sort of other signals of fundamental news flow, you know, and to see whether the CP Plus updates correspond to that.
Yeah, thank you. Yeah, but I think it's also very useful to know what the next trade will be, where the market's going to be, whether it's, I mean, in my head it is. So thanks.
PK?
Yeah, this last couple of discussion, I think that raises important point. If CP Plus is designed to predict only the next trade and not the fundamentals, then it's a endogeneity issue then, right? So the trades determined by those CP Plus quotes, and you're regressing that on the CP Plus. So is it X causing Y or Y causing X kind of issue, right? It's very endogenous then.
Yeah.
I don't know if it's endogenous. I think what it's showing is that they have a particular objective function in mind, and that it looks like with respect to that objective function, they are able to get closer to that next trade price than the prior last trade that was reported. I mean, the last trade report is important in the fixed income market, right? The whole business of, discussions of post-trade transparency is all about whether last trade should be reported, how timely it should be, things like that, right? So, post-trade reporting is important. So the last trade is a useful benchmark in this market where there is limited transparency. But I think Pankaj, the point is that even if it predicts the next trade in stress markets, that may actually, may not be as useful because the trade price is dislocated. So it's predicting the next trade price correctly, but that trade price is dislocated, as was the prior trade. And so I think that leads to sort of inefficiencies, and possibly, it can amplify price dislocations if people are using that signal to participate in the market. So I don't think it's endogenous in the sense that I think, it's just a different objective function.
Okay.
I'll go ahead and ask a question as well. One thing I was wondering is, is there any concern that this CP plus reference price can be manipulated? In particular, I was wondering about these RFQs that aren't executed. It seems like maybe that's a way to manipulate this reference price at low cost, and then if people are using this reference price and I can manipulate it, could that be a problem? Do you have any thoughts on that?
Yeah, that's interesting. Yeah, I mean, that's something that we can think about. I think that the algorithm has a lot of data inputs. And so from our discussions with them, it's not, they're not putting too much weight on a single trade or a single RFQ. However, that's something that we haven't looked at. So they are, and a related point is they are very careful about eliminating outliers in the RFQ process. But yeah, I think that's an interesting point. And I don't know if Kumar, you want to weigh in also.
Thanks. Simon?
Hi.
Yeah, again on the the traders use the CP plus prices. I don't know. Yeah, if endogeneity is so much the problem, or my question is more towards if there's the chance of these prices becoming at some point sort of self-fulfilling. And I thought that maybe what could be interesting is I wonder whether this in the end makes prices less informative if there's sort of so much reliance on these, and then with the potential of what Josh just mentioned, manipulation of these prices as well by the ones that provide actually the quotes, if quotes should be actually so crucial for the determination of these prices. I mean, surely there are boundaries to what this can happen, but I wonder whether there's maybe some flavor to that, and a potential risk at least going forward with these prices becoming more popular.
Yeah, I totally agree. Yeah, and this is something that we've thought about and we can kind of add discussion on, but yeah, and overall it's beneficial for there to be a lot of competition for these generated reference prices, and not for there to only be one player in the market, for sure. And particularly as you mentioned that these CP plus prices are now going to be incorporated in the the evaluated prices that funds are using to mark end of day. So yeah.
I think related to this is that these are indicative quotes, so they're not subject to the same market discipline as executable quotes that we may see in, say, equity markets, right? So I think the points that you make are important and related to that point as well, because these are indicative. You can throw out a quote and still not face the repercussions that you would face if you're throwing out a quote that is executable. So
Tavi?
Sorry to be hogging this. So one thing that you were talking about was the stress. And now, so these algorithms, do they train themselves? I think I heard you say that they train themselves on very frequent data. So if you're in a time of stress, when they're training themselves or when they're adjusting, whatever the right words for that are, is there a concern that, on the flip side, not from what do we learn from the next trade side, but what are the algorithms, those indicative quotes that are, I did look at this a little bit in the machine learning paper I did, but so then we found that when we tried to train our thing, it was, in times of stress, it was of course producing quotes, right? Or here you've got quotes being produced. I was looking at something else, but they were warped. So it's not just, Kumar, I think what you were saying, that the prices are maybe following something in a bad time, but that the AI algorithm is producing perhaps warped indicative quotes. That it doesn't know how to produce indicative quotes because it's based on something. And then the market conditions are so different from what it's used to.
I think that so the algorithms are trained nightly to pick up kind of changing interactions between all the features they see as important. And so I didn't get time to show it, but we see that during, for example, COVID, when for the bonds that were less traded, we see that CP Plus actually does a pretty good job. When for the bonds that were traded more, it doesn't do as a good job. But we also see that it seems to do pretty well in times of stress. So we see increases in its performance, like for example, when the VIX is high. But at the same time, we also see cases where the algorithm, if it is very quick to turn off if it's not comfortable on producing a quote.
Okay.
So there are some cases, and it's not that we don't see that very often in the later data, but around COVID, where we see that the algorithm just stopped producing quotes around, for example, COVID. John?
Yeah, I was wondering, so you've primarily looked at how informative the CP Plus quotes are to the next actually executed trade. Have you thought to see how informative they are in terms of the RFQ response process, i.e. like if you have an RFQ process where the RFQs significantly deviate from the current CP Plus quotes, is that less likely to result in a trade outcome or something like that as well?
Yeah, that is for sure, and that's a good point. So, the CP Plus generates minute by minute bid and ask, right? At the time of the RFQ, the submitter observes the CP Plus bid and ask. Then they also observe the quote responses, right? So when the quote responses are outside of the CP Plus bid and ask, only 6% of them end up being selected. So it is true that the winning quotes or the selected quotes are definitely inside and closer to the relevant side of the CP Plus quote.
Okay, thanks.
Mm-hmm. Yeah, and that does come back to the point that everybody's talking about whether these prices are influencing the next trade outcome also, I think.
All right, well, I don't see any other hands up, so unless there are any more questions, let's thank Stacey one more time. And thanks to all of you for attending. We hope to see you all again in 2 weeks for our next meeting of the Microstructure Exchange.
Thank you so much for your valuable comments. I appreciate it.